What up, Trusted Signals? Welcome back to the channel, and today we're going to talk about something extremely important: risk management and trade psychology. Very important things that you need to become a successful trader. The biggest issues people have when being a new trader is trying to make $1 million in one day or try to quadruple their account on one trade. And that's a real big issue because people blow their accounts, it messes with their psychology, you're over leveraged, and when you are over leveraged, it messes up with your psychology. It is just hand in hand. Why? Because you start seeing your account on a big negative drawdown and you start freaking out. So when you apply risk management and have the proper trade psychology, you become a solid trader. We're gonna go ahead and dive into this, and I wanna announce something real big for the Trusted Signals family. Please like and subscribe. Do check out the upcoming videos. You don't wanna miss all the free content that's coming out, all the updates that's coming out on Trusted Signals. It's all inclusive. All you gotta do is hit that like and subscribe button. So enjoy this video, and let's go! Welcome back. Let's go ahead and dive into this. I have GJ pulled up, and the first thing I want to go over is risk management. It's very important because if you have proper risk management, it's going to help out your psychology a lot. So here, we're going to use this buy signal as an example. Let's go long. If you were to see this support line created by Trusted Signals following a buy signal, it would be a great time to buy. You could go ahead and take your trade up to the previous support line or the previous sell signal just to be safe, and taking your stop loss under this wick. Now on TradingView, it tells you how much pips your stop loss is, how much pips your take profit is, and your ratio. Here it says we have 152 pips to almost 200 pips, and we're looking at a 1-to-2 ratio, so it's pretty good. Now the way that you want to calculate your lot size is by the amount of pips that your stop loss is. You want your stop loss to be no more than 3% of your account. Now, of course, with time and skill, you could go ahead and up your lot size and risking more of your account size with knowing what you're doing in the market. If you have a lot of confirmations, if there's a strong fundamental data, then taking your risk up won't really hurt you because you know what you're doing. But with new traders, they want to add a humongous lot, not know what they're doing, and putting their account at risk. And that is what the big problem is being a new trader. Having humongous lot sizes on a small account that can't really hold it. And by the time you're negative 100 pips, which happens easy on GJ, boom, your account is blown. All right, so let's calculate what lot size and how to calculate lot size. So with 152.1 pips, we're gonna use an account example with $1,000. So first thing you're gonna do, you're gonna get your account size. Your account size, let's say, is 1,000. So $1,000. What is 3% of 1,000? You're gonna multiply by 0.03, and that is $30. So if you lose this trade, you only want to lose 3% of your account, $30. Already your psychology is going to be way better. You're not going to be freaking out because you have already accepted the fact that you're willing to risk $30 for this trade. Okay, so now we know that 30 is 3% of 1,000. And we want 152.1 pips to equal $30. So you're going to divide this by 152.1, and it's going to be 0.19. Now to get this into a lot size, you're going to go ahead and divide this by 10. Now you have a 0.19. So you could either take a 0.01 or a 0.02, actually 0.02, by rounding this 9 off. So your lot size would be 0.02 taking this trade with a $1,000 account risking a 3% on this trade. That's how you would calculate your lot size, and calculate your risk. You should do that with every single trade in the beginning. Every single trade. Now with time, when you become more skilled and you've practiced a lot your entries, and your entries are more solid and more solid over time, then you could go ahead and risk more. It's totally fine. People do that all the time. But I still highly recommend to keep this as a standard every time you trade. So that way you protect your account. So that means if you're risking 3% of your account every single time you trade, then it's going to take you a lot of trades to blow your account. And if you're winning more than 50%, 60% of your trades, then risking 1 to 3%, you're going to be in profit, even though you're losing some trades. Why? Because you've calculated your risk and you're only risking a small percentage of your account. Okay, let's carry on. One thing to really think about is how risk management affects your psychology. If you see a large percent of drawdown on your trade, automatically you're going to be freaking out. You're going to be really stressed and scared that you're losing your money. But if you take this into practice and use proper risk management, I guarantee you your psychology is going to be stronger and you're going to have more confidence in your trade. Because when you see your trade going opposite of your trade idea, you're not freaking out. You've already priced in that risk, which you're not afraid to lose. So when you see it in drawdown and you're only risking a 1 to 3%, you're going to be relaxed. You're going to let the trade play out. You're going to stick to your analysis. You're going to be a stronger trader. All the psychology comes with the amount of risk that you're having in a trade. Another thing that happens a lot with traders is the fear of missing out. For example, here this buy signal came in. We're seeing a nice push to the top. People would say, oh my God, market's going up. Let's go ahead and enter as a buy. That's the biggest mistake. Or I lost the opportunity to enter here. I'm going to look to enter here as a buy and hopefully continue to catch this movement. That is the biggest mistake that you can make. The other way of thinking, the correct way of thinking is, hey, this buy signal came in. After this buy signal, we should then soon see a sell signal come in. Let me prepare my mind to enter on a sell to catch the next move. Or if you know that Great British Pound is stronger than JPY, you could also say, hey, I seen this buy signal come in. I'm going to wait for a sell signal, not take it, wait for it to catch some support, and enter on the following buy signal. This way, you're going with the market. You're not going against the market. You don't want to go against the market. You want to go with the market at the right entry points. So everything is in reverse. If you see the market coming down and you're at a very low point in price, then you should calculate a buy in your mind to go in a buy with the direction of the market. If you see the market going all the way up and you're at a high point of the market, you want to mentally prepare yourself to take a sell, to go flowing with the market. So not doing the obvious trade, which every retail trader is going to do, but to do the opposite and think like an institutional trader. So these things together and using trusted signals is going to help you extremely. It's going to make you a profitable trader. It's going to give you more consistency. It's going to give you the trade system that allows you to have that edge over the market. So that's it. This sums up the video. Thank you so much, Trusted Signals. Be sure to like and subscribe, throw the comments, share the videos with your friends, and join the family. Thank you so much. Trusted Signals, let's go!